Welcome to the deep dive. Today we're really getting into Air China's 2024. We'll be looking at their performance, where they're headed strategically, and, their overall outlook.
That's right. And we're basing this on their official 2024 annual report. It's packed with info.
Exactly. So think of this as your express lane through that big document. We want to give you a really clear picture of Air China right now, where they stand, and what the future might hold, without you having to read the whole thing.
Our mission essentially is to distill those key insights for you. We'll hit the main business areas, the financials, of course, and their strategy going forward.
Okay, let's set the stage first. The report mentions the general economic climate in China improving in 2024 and the aviation market bouncing back quite a bit. How much of a factor was that?
Oh, it's huge. You can see Air China really leaning into that recovery. They talk about seizing market opportunities, which makes sense. But they also stress doing this while ensuring safety, which is always number one in this industry, and focusing hard on improving the bottom line, their financial results.
Right, getting those numbers looking better after a tough few years.
Precisely. That context, that recovering market, kind of underpins everything else they did strategically during the year.
And one of the biggest things seems to be just flying more. The report mentions a 22% jump in available seat kilometers, ASK. That sounds massive. 356 billion ASKs. What does that signal?
It really does signal a major ramp up. A 22% increase, yeah, that's aggressive. It shows they were anticipating a lot more demand and were willing to put the planes out there.
But does that come with risks, like outstripping demand?
It certainly can. You have to fill those extra seats. But interestingly, a huge chunk of that increase came from their international routes. They basically doubled international capacity compared to 2023.
Doubled. Wow. Was that purely commercial?
Not entirely, according to the report. They explicitly link it to supporting national diplomacy efforts, too, alongside reopening old routes and launching new ones. Their mantra seems to have been consolidating existing capacity and expanding incremental capacity. So growing, but strategically.
So not just adding flights randomly. The report talks a lot about developing hub networks. Why are hubs so crucial?
Hubs are the backbone, really. Focusing on those key regions, Beijing, Tianjin, Hebei, Chengdu, Chongqing, the Greater Bay Area, Yangtze River Delta, it lets them funnel passengers efficiently.
Makes sense, like connecting flights.
Exactly. Passengers flying between smaller cities can connect through these major hubs, like Beijing Capital or Chengdu Tianfu, which they're building up as major international gateways. It improves aircraft use, smooths out operations, and ideally gives passengers better connections.
And that international focus, it wasn't just the usual big destinations, right? They mentioned the Belt and Road Initiative specifically.
Yes, that's a distinct part of their strategy. They've actively expanded routes connecting to countries involved in the Belt and Road Initiative. We're talking 65 routes across 29 countries by the end of 2024. It aligns with China's broader economic goals.
So a global network with a strategic overlay. How many routes total?
End of 2024, they reported operating 847 passenger routes, 657 domestic, and 190 international or regional, covering 45 countries and regions. It's a pretty extensive network.
And you need planes for all that. The report highlights support for domestically produced aircraft. What's the story there, and what does the fleet actually look like now?
Right, the domestic aircraft angle is interesting. They're operating the COMAC C909 and C999 on a larger scale now, and even mentioned aspiring to be the first airline globally to operate the C929. It's likely a mix of national strategy support and perhaps long-term diversification.
So what planes do they actually have?
As of the end of 24, the report lists a mix. 22 Airbus A320s, 4 A330s, 13 Boeing 737s, 2 B787 Dreamliners, plus 2 of the COMAC C909s and 10 C919s. A total of 47 aircraft listed in that specific section, though the total group fleet would be larger across subsidiaries. They're also focused on using those planes efficiently, getting the daily utilization rates up, which they apparently achieved year on year.
Okay, beyond just the flights, what about the passenger experience and marketing? Airlines are always trying new things there.
They seem to be quite active. The report mentions a quarterly product release cycle, which suggests they're trying to be agile. They're refining products for inbound tourism, which is obviously recovering.
And targeting specific markets.
Yes, focusing on connecting flight markets, aiming for specific market shares, tweaking base pricing, and making what they call precise capacity allocations, trying to match planes to routes better. They're also doing things like upselling strategies and creating specific inbound travel packages.
Trying to get more revenue per passenger, basically. What about those extra fees, ancillary revenues?
Yeah, that's definitely part of the picture. Like most airlines now, they're looking beyond the base ticket price. The report mentions refining how they manage seat selection services and launching something called the Business Travel Prime Zone. It's all about finding those extra revenue streams.
Makes sense. The report also uses the term digital transformation. What does that mean for Air China in practice?
It seems pretty broad. They're applying digital tools across safety operations, marketing, customer service, and internal management. For example, using platforms for visual flight monitoring, smarter flight scheduling, and even mobile apps for ground crews.
So, operational efficiency.
That's a big part of it. They also mention an operation monitoring platform for managing the entire process and handling disruptions better. But it's also about using tech for marketing innovation, potentially new business models, and improving service quality. It sounds like a fairly comprehensive push.
Flying globally isn't without risks, though. How are they managing that side of things?
They seem to have a structured approach. The report talks about a solidified risk assessment mechanism, doing deep dives annually into major operating risks, and putting countermeasures in place. They're trying to get better at quantifying risk, making it more precise, and building early warning systems.
Is it integrated into decisions?
They say it is. Integrated into corporate reforms, core tasks, major projects. And they mention having clear lines of defense for risk control and compliance. Standard practice for a large airline, but they're emphasizing it.
Okay, looking forward now. 2025 is a big year, end of a 5-year plan. What's the strategic message?
The key phrase seems to be seeking progress while maintaining stability. Typical planning language, maybe, but it suggests balancing growth with caution. Priorities are safety. They always emphasize that strengthening strategic capabilities and speeding up development of new business models.
Aiming high.
Very high. The goal is stated as achieving high-quality development and becoming a world-class enterprise. But they're also realistic, acknowledging that the international market recovery still faces headwinds.
And specific challenges.
Market fluctuations are mentioned as a key risk. Their strategy involves strengthening the domestic network while being selective internationally. And, crucially, for an airline with lots of US dollar costs and debt, they flag the risk of RMB exchange rate fluctuations. A 1% change against the dollar, they note, impacts net profit by about RMB 178 million. So quite sensitive.
Okay, that's a great overview of the operational and strategic side. Let's shift gears and dive into the financials. You mentioned revenue was up significantly.
Yes, quite significantly. Total revenue hit RMB 166.7 billion, roughly. That's an 18.1% increase year on year.
And most of that comes from flying passengers, I assume?
Correct. Air traffic revenue was about RMB 159.2 billion, also up just over 18%. But the really eye-popping number was international passenger revenue.
Ah, the doubled capacity effect.
Exactly. International passenger revenue jumped almost 75% compared to 2023, reached about RMB 37.4 billion. That shows just how much that part of the market came back for them.
And domestic.
Domestic passenger revenue grew too, but much more modestly, around 4.1%, hitting RMB 109.5 billion. Still growth, but international was clearly the star performer in terms of percentage increase.
Right, okay, revenue's up. But what about the costs of running all those extra flights? Did expenses keep pace?
They certainly did. Total operating expenses rose to RMB 171.8 billion, which is an increase of almost 18%, very close to the revenue growth percentage, actually.
So costs grew almost lockstep with revenue. What were the main drivers? Fuel.
Fuel is always a big one. Jet fuel costs went up about 15% to RMB 53.7 billion. But some other costs jumped even more sharply. Takeoff and landing charges, airport fees basically, surged over 34%.
Wow, 34%. Why so much? Just more flying.
More flying, higher charges at some airports potentially, maybe catching up on deferred maintenance leading to more ground time. Could he mix? Maintenance costs themselves, MRO, were also up nearly 30%. And selling and marketing expenses climbed over 37%, likely reflecting efforts to win back customers.
Okay, so revenue up strongly, but costs also up significantly. The report mentioned losses were reduced, though.
That's the crucial outcome, yes. Even though expenses rose substantially, the strong revenue growth, especially that high-margin international recovery, was enough to significantly narrow the gap. They didn't turn a profit according to these headline numbers, but the loss was much smaller than the year before. It shows a clear, positive trend financially.
Progress, as you said. What about other key metrics? Load factor, how full were the planes?
Load factor saw a good improvement. It reached 79.85%, which is up 6.6 percentage points from the previous year. So they were successful in filling a larger proportion of those extra seats they put into the market.
That's positive. But what about the price they got for those seats? The yield?
Ah, that's the other side of the coin. The yield per revenue passenger kilometer, RPK, basically The average fare paid per kilometer flown actually decreased. It fell by about 12.4% to RMB 0.5338.
So fuller planes, but maybe lower average fares. Why would that be?
It could suggest increased competition, especially on those recovering international routes. Airlines might have been using lower fares to stimulate demand and rebuild market share, so more volume, but potentially at a lower unit price.
Interesting trade-off. Let's quickly look at the balance sheet. What's the debt situation like?
Total liabilities at year-end were RMB 304.8 billion, slightly up, about 1.6% from 2023, but the structure changed a bit. Current liabilities debt due within a year increased, particularly interest-bearing short-term debt, which shot up over 40%.
More short-term debt.
Yes, while non-current longer-term interest-bearing debt actually decreased by nearly 15%, it might reflect refinancing activities or shifts in borrowing patterns. Also notable, their capital commitments, mostly for buying new aircraft, jumped by 32% to over RMB 95 billion. They're planning significant fleet investment.
Big future spending planned. And cash flow. Anything particularly stand out in 2024? Financing activities seem busy.
Very busy on the financing front. Lots of loan repayments and new borrowings, managing lease obligations. But the big items were two significant share issuances. They issued 8 shares listed in Hong Kong early in the year, netting about HKD 2 billion.
And later in the year.
Later in December, they issued 8 shares domestically, raising almost RMB 6 billion net.
Why raise all that capital?
The stated reasons were pretty broad but strategic: strengthening the fleet, boosting their competitive position, adding working capital, and generally improving their financial structure and ability to withstand risks. Basically, shoring up the balance sheet and funding future growth.
Okay, that makes sense strategically. Which brings us to shareholder value. A lot of listeners, especially potential investors, will want to know any dividends, any share buybacks mentioned in this report.
Yeah, that's always a key question. The direct answer from the 2024 report is no specific plans for dividends or share buybacks were detailed for the reporting period itself.
Okay, so nothing concrete announced there. But can we read between the lines? Is shareholder value part of the picture, even indirectly?
I think you have to see it indirectly, yes. Yeah. While there's no immediate cash return promised via dividends or buybacks in this specific report, their entire strategy is arguably geared towards long-term value creation.
How so?
Well, successfully executing the growth strategy, improving that load factor, and critically, continuing to reduce losses and eventually return to sustained profitability. That's the fundamental way they create value. The report highlights the loss reduction as progress.
And the share issuances, doesn't that dilute existing shareholders?
It does in the short term, yes. But the argument is that strengthening the balance sheet with that capital makes the company more resilient and financially sound for the long haul. Using those funds for, say, modernizing the fleet should improve competitiveness and future earnings potential. It's an investment for future value, even if it dilutes ownership slightly now. Plus, they mention commitment to corporate governance, which is also important for investor confidence.
So the focus seems to be on building a fundamentally stronger airline first, which should translate to shareholder value down the road rather than immediate payouts right now.
That seems to be the implication, yes. Building the foundation.
Okay, wrapping things up then. Based on this deep dive into the 2024 report, what's your overall assessment? How does Air China look moving forward?
I'd say the picture is one of significant recovery momentum, particularly internationally. They've shown they can ramp up capacity and capture returning demand. Their strategic direction seems clear focus on key hubs, fleet modernization, including those domestic planes, and digital transformation. That all points towards aiming for growth and efficiency.
But challenges remain.
Definitely. Operating expenses are a major factor to watch, especially fuel and those airport charges. The yield pressure we talked about is another. And external factors, global economic conditions, geopolitical stability, exchange rates, those are always big unknowns for any international airline. Their success will depend heavily on navigating those external factors while executing their internal strategy.
And their ambition.
The ambition is clearly stated: become a world-class enterprise aligned with China's national goals. It's a lofty target, but it provides a clear direction. Safety, as always, remains the bedrock. The transition into the next 5-year plan period will be critical for them.
So a mix of strong progress, clear ambition, but also notable headwinds and dependencies. For you listening, maybe think about that balance. How do you weigh Air China's growth plans against those external economic and market pressures? What are the biggest hurdles you see for them reaching that world-class status? It might also be interesting to look into the wider Chinese aviation market dynamics and how government policies continue to shape things.
Absolutely. Lots to keep an eye on.
Well, thank you for joining us on this deep dive into Air China's 2024. We hope this gave you some valuable insights. Until next time.